Hey guys, Brian Stevens here coming from Casa de Brian. Listen, today's show is brought to you by Loan Tech. So if you're looking at converting your online leads, which you should be doing, Loan Tech is here to help you, and they're going to give it to you free for 6 months. All you have to do is click this banner right over there, or if you're catching us on Facebook, right up above. So today's show is the second installment of my interview with David Stevens last week, and this is a very important show because loan officers, I think oftentimes when I speak with Dave Stevens, that these conversations don't necessarily reflect what's going on the ground with you. This is different. GSE reform is something that does affect you. I've always been a person who said, let's recap and release. Let's call it a mulligan. But after reading the MBA's white papers, they have great points, and this reform does in fact need to happen because it's going to help you and the consumers. For example, did you know from 2004 to 2010 that the 10 largest banks went from 40% to 80% market share? How did they do that? Well, would it surprise you to hear that they were getting discounts on their G fees based on volume? Would it surprise you to hear that they were getting extended credit programs based on volume that you simply couldn't provide? Think of Friends of Angelo. How did that one work out? The Mortgage Bankers Association's recommendation to Congress through their white papers is going to create a level playing field where the small lender can compete on an absolutely level playing field with the largest lenders in the country. Now, I gotta tell you, I have to imagine that this has some big banks out there probably not terribly happy with the MBA. But what they're doing is really protecting the mid-size, the regional banking operations, which is what most of you are. So check out this show and get on board with the MBA's proposal for GSE reform.
At a time when I think almost everybody is very frustrated with the political arguments that are going on, and it's dividing families and friendships and everything else right now, depending where you sit. I have great respect for the Senate Banking Committee and its membership, and Chairman Crapo, who I think most of you know is a Republican from Idaho, and the ranking member is Sherrod Brown from Ohio. They're actually longtime good friends. They disagree politically on many things, but they actually get along extremely well, and you can say that for many parts of the committee. And so one thing we have to our advantage as we think about GSE reform is A, it's not a partisan issue. It's not separating people along political lines, like getting rid of quote unquote Obamacare might be, or even tax reform may enter into that space. It's a technical issue, but it's about housing. It doesn't have a partisan mother or father to this one. And so it's easier to talk about. And so the Senate Banking Committee for many months leading up to the very first hearing of a couple weeks ago held a variety of listening sessions, typically on Fridays, and they invited in stakeholders to come talk about framework and principles and technical aspects about capital and transition. And we were one of those experts. I personally was called twice to meet during those sessions. And then Tom Kim, who has my multifamily area here, he also went up to talk about just the multifamily. So they've been very thoughtful in the process. In addition to that, Senators Corker and Warner are kind of putting the band back together from the old Corker-Warner effort during the previous presidency, and they're as well working within the committee construct to try to work on the subject. So they held their first hearing. It was interesting. I've done a lot of testifying in front of Congress. This is the first time I've ever done a hearing where there's only one panel and only 3 witnesses. So it was really, the introductory sort of orienting hearing to what's going to be a couple more on GSE reform. But I was the only person technically from industry. I testified, obviously, representing the Mortgage Bankers Association, which represents multifamily, single-family, bank, non-bank, large, small, medium, you name it, every model. Ed DeMarco, who was the former acting director of the FHFA, and the third witness was a consumer advocate, Mike Calhoun. We all actually agreed, from the consumer advocate to the business side to former regulator, that legislative GSE reform is needed. And in many ways, we agreed to many of the core principles. And it was clear from the testimony, and I know every member of the committee, or almost every member of the committee, pretty well after working with them for all these years. They really care about the issues. They've learned a lot from the last exercise of Johnson Crapo, so they now understand the variables of GSE reform. Their staffs have been actively engaged ahead of time. And so, I view this time with much more promise for success. It's nonpartisan. We have a committee that's learned a lot over the past several years of talking about this. They're working together as a bipartisan effort, and all the committee hearings with staff even are bipartisan, where you have the Democrats and Republicans both together. Hard to tell them apart when we're talking about these subjects.
Good.
So it was a good experience, and I think as we go forward, we're going to start to see them drafting proposed language for legislative reform.
And by the way, for those of you who are watching this, if you want to check this out, it's called The Principles of Housing Reform or Finance Reform, testimony of David H. Stevens, and it was published on June 29, 2017, and we have the link right here. I think you should really check it out. There's some interesting things and really kind of a backstory as to why we have to, protect smaller banks, amongst other things. Now, would it be fair to say that one of the reasons, amongst others, I'm sure, that you don't support recap and release is because if we did that, we've got investors who are then going to go in and put money in, and when things are going great, they're going to benefit. When things are going bad, it's going to be the burden of the taxpayer. Would that be an accurate statement?
Yeah, I think a core principle, and by the way, whatever you read in trade journals or media on this subject, everybody's arguing their points. I would tell you that if you talk to the legislators and to the Trump administration, and I spent a lot of time in the White House and the Treasury Department with the leadership that's working on the same topic, there's a common agreement amongst everybody. And that includes, Elizabeth Warren to Chairman Crapo or Senator Corker, that the duopoly model that ultimately resulted in conservatorship, to your point, Brian, where taxpayers win in good time, shareholders win in good times and taxpayers pay the cost in bad times, has to end. And so, that's a common theme. I will tell you my own view, and this is why I think reform is so critical now, and I just encourage everybody to think about this. One, Mel Watt's term expires at the end of next year. Whether he stays the whole term or not is a question, but, a year, almost a year and a half to me is like tomorrow in Washington time.
Sure.
We're going to have a new regulator in there, and that regulator may have an entirely different view on how big or small the role of the government should be in housing finance. If they think it should be smaller, they can raise guarantee fees. They can scale back loan limits. They have extraordinary authority to do whatever they want. And so, in order to protect liquidity to the housing finance system, if for nothing else, we need to remember that under the current aspects of conservatorship, everything that makes us sort of think that the normal is works and why not keep it is going to become at risk in a little over a year. So that's point number one. The second point I would highlight is in the decade prior to conservatorship, 2004 to 2010, let's be clear, and this is in our paper, 2004 to 2010, a concentration of market share amongst the top 10 lenders who originated through the GSEs went from 40% to 80%. So when the GSEs were free prior to conservatorship, they were cutting market share deals with the biggest lenders. They were making credit terms available only to a handful. Remember the fast and easy loan for Countrywide was a unique and exclusive credit waiver from Fannie Mae in exchange for 100% market share or close to that. If we're gonna lock in a level playing field for lenders into the future, you can only do that legislatively. Otherwise, you're dependent on hoping the FHFA director will continue these protections. And previous regulators didn't. And my own view is, failure to remember history is going to mean you're guaranteed to repeat it. And so from our view, we need to lock in a level playing field, a transparent market, one where pricing is transparent, credit terms are transparent, everybody gets the same deal, no special deals cut for anybody based on market share or the fact they're liked better or they say good things about a particular guarantor. And we need to remember that the false confidence we feel today because things are working, why change it? That's going to change as the new regulator changes, and I can assure you, and I've heard some of the names that are being suggested as possible candidates for this administration, everybody should be really weary about, one, we depend on the flow of capital from these two companies, and you can disrupt the heck out of it pretty easily in the future. So, at a very high level, that's it. Obviously, we go into a lot more as to what's needed in our paper, but that is fundamental. And if you're a loan rep with not one of the super large lenders in this country over anybody else, you should be wanting to make sure we legislatively protect the level playing field and transparency in pricing and credit terms. That can only happen legislatively. I would just add one more thing, Brian, sorry, without going too long here. We also need to have an explicit guarantee on the MBS. The GSEs only have an implicit guarantee by their charters. They were to simply release, and there's been great articles written on this by Bloomberg and the Wall Street Journal. International investors who buy mortgage-backed securities, they're going to discount MBS significantly. They trusted in the implicit guarantee last time the GSEs were put in conservatorship. They're not going to have that same trust this time. So the spread between Ginnie Mae and agency MBS would widen out even far more significantly if we release them with only an implicit guarantee. So locking in the level playing field, locking in a pathway forward with competition and transparency, and locking in the explicit guarantee, these are things that are really critical. And we have a chance now to get it done in a Congress that is really aligning around a lot of these core principles.
Great stuff from Dave Stevens. It's my goal sometime this week or maybe the following week where I can get Dave Stevens on board on maybe a FaceTime Live where we can do some live Q&A with you guys so you can ask your questions about what your industry is going to look like in the coming years. Because guys, like it or not, this is happening. With that said, make sure you forward this to other people in the industry. It's a big one. And make sure you subscribe if you're seeing this for the first time and tag people and let them know what we're doing. It helps us out. We'll see you tomorrow. Bye.